Iron Financial, the only place you need to be to forge a stronger portfolio and hammer out market weakness. I'm your lead analyst, and today we are putting Roper Technologies squarely under the microscope. They just dropped their Q4 2025 numbers, and, on the surface, this thing looks like an absolute fortress of growth. But we don't deal in surfaces here. We bring the heavy equipment. We're going to stress test this company from the foundation all the way up to the roof just to see if it's truly built to last, or if it's just a house of cards waiting for a strong wind. Let's get to work. Okay, right out of the gate, Roper posts a massive number for their full year 2025 revenue growth, plus 12%. Now, in this market, that is not just strong, that is dominant. This is the kind of number that tells you the machine is running hot and every single cylinder is firing. You have to understand, a 12% top-line growth for a company of this size, that's a statement. It's a declaration that their strategy is not just working, it is accelerating. It's the mark of a well-oiled, incredibly powerful machine.
Whoa, hold on a minute, LA. A 12% headline number looks fantastic on a PowerPoint slide, for sure. But I've seen plenty of beautiful blueprints that lead to completely collapsed structures. So before we start popping the champagne here, I need to know what's actually holding that number up. Is this genuine solid steel growth coming from the core of the business? Or do they just go out and bolt on a bunch of prefabricated parts and call it a skyscraper? Because, let's be honest, one of those can withstand a storm, and the other one, well, it just looks good right up until the first crack appears. So let me ask again, how's the build quality on that 12%? That's an excellent question, and it's exactly why we have a plan. We are not just kicking the tires today. We are conducting a full top-to-bottom structural inspection. So here's our agenda. First, we'll review Roper's official blueprint for growth. Then, we're going to get our tools out and inspect those top-line numbers you're so skeptical about. After that, we move to the heavy lifting, stress testing the 3 core pillars of the business. From there, we'll check the financial foundation. We're talking cash, we're talking debt. We'll then take a hard look at their 2026 outlook. And finally, we will deliver the Iron Financial verdict. It's a clear roadmap for a thorough inspection. All right, let's dive right into this. Our first stop, we need to understand the architect's vision. We are looking at Roper's blueprint for growth. This is the high-level strategy and the headline performance that they're pitching to all their investors. Basically, this is the story they want you to believe. And you have to admit, the story is impressive. Let's be very clear. As you can see from their 2025 highlights right here, it was a year of what they are calling solid execution. Revenue up 12%. EBITDA, that's your earnings before interest, taxes, depreciation, and amortization, up a really powerful 11%. And free cash flow grew a solid 8%. But what's really interesting here, what tells the true story, are those bottom 2 lines. They deployed a massive $3.3 billion on acquisitions, and on top of that, they bought back $500 million of their own stock. This tells you their entire strategy in a nutshell. Generate a ton of cash, then use that cash to buy more growth and reward shareholders. On paper, it is a flawless execution of a classic compounder model. Flawless execution. Or a shopping spree that was funded by a whole lot of debt. That's the real question, isn't it? So now we move from their pretty blueprint to our inspection. It's time to crack open that 12% revenue number and see what it's really made of. Is this a solid brick fortress, or is it just a pretty facade hiding something much weaker behind it? It's time we separated the marketing from the material facts. And here we have it. Okay, this breakdown tells a very, very different story from that big headline number, that impressive 12% growth. Well, as this chart clearly shows, a staggering 58% of it came from M&A. That's mergers and acquisitions. They went out and bought 7 percentage points of that growth. So the organic growth, the growth that actually comes from their existing businesses selling more products and services, was only 5%. Now, don't get me wrong, 5% organic growth is decent. It's not bad at all. But it is not the 12% juggernaut the headline suggests. This company isn't so much building a skyscraper as it is buying other, smaller buildings and just stacking them on top of each other. That is a fundamentally different, and I would argue, much riskier way to build. Yeah, let's just break this down. You can see it on the screen. Building growth organically from the inside out, that's really the gold standard. It proves your core business is strong and your strategy is sound. It's sustainable. But, it's also slower. It's the hard work of building brick by brick. Buying growth, which Roper absolutely loves to do, is the fast track, but it always comes with a price. You've got integration risk, you've got the risk of overpaying, and most importantly, it almost always adds a pile of debt to the balance sheet.
I see your point. But for Roper, this isn't a bug. It's the entire feature. This is their whole model. They are a serial acquirer. You see it as a risk, but I see it as their core competency. They have a proven, decentralized process for identifying and integrating these niche, high-margin software businesses. They've done it successfully for years and years. They're professional builders who use prefabricated, high-quality components. It's just faster and, frankly, more efficient.
But even the best builders can get a bad batch of materials. Or the cost of those materials, which is financed by debt, can start to eat into the project's profitability. And that's the tension here. We need to see if that strain is starting to show up in the core of the business. Agreed. So let's move on to the stress test. It is time to examine the main structural supports of this entire company. Roper is built on 3 core business segments. We are going to inspect each one, pillar by pillar, to see if they are as solid as they appear on the surface. First up, we're looking at the main pillar, application software. This is by far Roper's largest and most important segment. It represents the bulk of their revenue and their profits. We're talking over 60% of the entire business right here. If this pillar is cracked, the whole structure is in jeopardy. So let's see how it performed in the fourth quarter. And the numbers look incredibly strong. I mean, this pillar is solid granite. Just look at this table. Q4 revenue is up 10% year over year. That's fantastic. But what's even better is that EBITDA is up 11%. And when your earnings grow faster than your revenue, that means your margins are expanding. We see that right on the bottom line. EBITDA margin expanded by 70 basis points to an incredibly healthy 42.2%. This is a high-quality, cash-gushing business. This is the engine of the Roper machine, and right now it is firing on all cylinders. The engine might be firing, but I definitely hear a few sputters. This is what you find when you bother to read the fine print of their report, not just the headline tables. Management admits the government contracting market, or GovCon, which is a key part of their Deltec business, remains challenging. And they explicitly state that another one of their businesses, ProCare, underperformed. Now, these aren't my words, these are theirs. So while the overall pillar looks shiny and strong, there are absolutely signs of wear and tear. These are what I'd call hairline cracks. Are they a problem right now? Maybe not. But hairline cracks have a funny tendency to become major fractures when they're put under pressure. We need to watch this space. That's a fair point. Let's move our inspection to the second structural support. Pillar number 2, network software. This is another key software segment for them, and it comprises their big data and analytics businesses. So let's put it through the exact same stress test. Whoa. Okay. Now this is more than a hairline crack. To me, this looks like serious structural fatigue. Just look at this data table. Revenue growth is fantastic, right? Up 14%. The market loves to see that. But look at the lines below it. EBITDA only grew by 5%. How in the world do you grow revenue by 14%, but your profits only grow by 5%? Well, the answer is right there on the last line. Massive margin compression. The EBITDA margin here fell by 460 basis points. It collapsed from over 57% down to under 53%. That is a huge red flag, Alay. A huge one. It is a flag, you're right. And this becomes the critical question. What is causing this pillar to weaken? It suggests that 14% revenue growth didn't come cheap. Did they have to spend a fortune on marketing? Did they have to cut their prices just to win deals? The company points to the mix impact from some recent acquisitions like Subsplash, which naturally run at a lower margin. But that brings us right back to your earlier point, doesn't it? Buying growth can sometimes mean you're buying lower quality growth. This kind of margin erosion is a serious concern, and it tells me this pillar is carrying a very heavy load and it is starting to show the strain. All right, let's inspect the third and final pillar of the operating business, technology-enabled products. Now, this segment is a little bit different from the others. It's less pure software and more of a mix of hardware, medical devices, and industrial tech. Let's see if it's holding up its share of the weight. And this pillar is the very definition of steady. Rock solid. Revenue grew 6%, EBITDA grew 6%. That means the margins were perfectly flat at a very respectable 34.8%. This isn't the high-flying growth of the software segments, but you know what? It's reliable. It's consistent. This is the dependable, steel-reinforced concrete pillar in the corner that doesn't get a lot of attention, but it does its job year in and year out without any drama. It provides a solid base of predictable performance for the overall company. No cracks to see here. So we've inspected the 3 main pillars. One looks strong, but with some minor cracks. One is showing signs of pretty serious margin pressure, and one is just slow but steady.
Exactly. So now we need to go deeper. We have to check the foundation that all these pillars are actually built on. We're talking about the balance sheet. We are inspecting the cash, the debt, and the overall financial durability. Because let's be honest, if the foundation is weak, it doesn't matter how strong the pillars are. The whole thing will eventually crumble.
And that foundation starts with this number, $2.47 billion. That is the amount of free cash flow that Roper generated in 2025 alone. This is the bedrock. This is the pure, unadulterated cash the business throws off after all of its expenses and investments are paid. This is what gives them the power to make those acquisitions, to buy back shares, and to weather any storm. A company generating this much cash has an incredibly strong financial core. It's like a river of money that is constantly reinforcing the foundation. A river of cash is great, but it's flowing into a reservoir that has a pretty significant leak, and that leak is debt. This number, 2.9 times, is their net debt to EBITDA ratio. What that means is their total debt is almost 3 times their annual earnings. Now, while that's not exactly in the danger zone yet for a company with this kind of cash flow, it is not insignificant either. This is a heavy weight that is just sitting on top of that foundation. It's a constant pressure. And in a rising interest rate environment, that weight just gets heavier every single quarter. And this chart illustrates that point perfectly. This isn't theoretical, this is happening right now. Look at the rising cost of that debt. In the fourth quarter of 2024, their interest expense was $71 million. 1 year later, as the chart shows, it jumped to $93 million. That is a more than 30% increase in just 1 year. That is a crack forming in the foundation. That's $22 million per quarter that could have been used for R&D or for another acquisition that is now just going straight to the bank. The debt isn't just a static number on a page. It is a growing burden on the company's profitability. That is a crucial point. So let's turn our attention to management's blueprint for 2026. We've inspected the current structure, and now we need to see what they're planning on building next year and if they're projecting continued strength or if they're actually preparing for a slowdown. And the guidance, it looks solid. As you can see here, they're guiding for about 8% total revenue growth. Now, crucially, they expect their organic revenue growth to accelerate to somewhere between 5 and 6%. This is a sign of a confident management team. They see the momentum continuing. Confident, maybe, but let's put that 8% in context. They just delivered 12% total revenue growth in 2025. Now they're guiding to 8% for 2026. That is a significant deceleration, a 1/3 drop in the growth rate. So while they are still growing, the pace is clearly slowing down. The question you have to ask is this just them being conservative, or is this the new, slower reality for a company of this size that is carrying this much debt? Which brings us to the end of our inspection. We have reviewed the blueprint, we've stress-tested the pillars, and we have checked the foundation. We've seen the good, the bad, and the questionable. So it is time to put it all together and deliver the Iron Financial final verdict. So here is our final inspection report. On the strength side, the structural integrity is undeniable in certain places. The cash flow generation is absolutely immense. It's a true powerhouse. Their M&A engine, as we discussed, is a proven machine. And they are composed of a diverse set of high-quality, high-margin software businesses. These are the steel beams of the structure. However, the potential cracks that we found simply cannot be ignored. The heavy reliance on acquisitions to fuel that headline growth number is a major one. The significant and growing debt load is a clear stress point on the foundation. And we saw clear evidence of margin pressure in a key segment, which raises very serious questions about the long-term profitability of their growth by acquisition strategy. So, what's the final verdict from Iron Financial? Look, Roper has built an impressive fortress. It is big, it is powerful, and it is clearly built for growth. But our inspection shows that it's a fortress built for peacetime, for an environment of cheap money and easy acquisitions. The real question is this: can it withstand a siege? What happens when interest rates stay high, making that debt load even heavier? What happens when acquisition targets become too expensive, and they have to rely on just that 5% organic growth? Roper is a powerful company, no doubt, but its very design, its reliance on buying growth, could be its greatest vulnerability in a tougher economic environment. The fortress is strong today, but the walls are showing cracks, and it's your job as an investor to decide if you believe those walls will hold. Thanks for joining us on Iron Financial. We'll see you next time.